Hi everyone. Every day, I like to analyze many different companies using this automated Excel tool. Let me show you how it looks. Etc. I really like this tool for three key reasons. First of all, it's perfectly aligned with Warren Buffett value investing principles. Second of all, it saves me a lot of time. The only thing I need to do is write down the ticker and everything will update automatically. And the third reason is that I saw a big boost in the performance of the portfolio of my equity investment firm. Today, I'd like to analyze Nvidia. So let's start by inserting the ticker of the stock. Here we go. Share price $177. I'm happy with that, but you can change down the line this share price. That's not a problem. So let's start with the first section of the toolkit, which has three sections. The first section is called Investment Summary, and in this section we've got 5 building blocks. The first one is the company overview. So here you'll have some key metrics such as market cap, earning, P ratio, etc. Second building block is called question 1, good quality company, yes or no. So here we try to identify whether or not Nvidia is a good company, basically. So to answer this question, we've identified 8 metrics, which are here. Okay. The first metric is earnings. We want a company that has positive earnings. I'm not saying that you cannot make any money by investing in a company that has no profit, but it's really not easy. And as a value investor, I like to assess or to estimate the intrinsic value of a company, and it's very difficult to estimate the intrinsic value of a company that has no profit. Okay, so earnings positive. So we want something above 0, of course. Here we've got 120 billion. Okay, so that's a tremendous profit for Nvidia. Second metric, we want future earnings growth above 3% at the very minimum. Ideally, I'd rather have 10, 15, 20%, of course, but you know, I like to have a minimum requirement. So here 3%. According to the consensus, we've got 26% of future earnings growth for Nvidia, so way above. Okay, keep in mind that if this number was, let's say, 2%, then it would be red. And as soon as it reds, here we've got the quality score that drops. Okay, so let's put it back. Here we go. Profit margin, ideally we want something above 8%, but once again we want way more than 8% ideally. So the actual profit margin, it's just an amazing number again, 56%. So very, very happy with that. Return on equity and return on invested capital should be at the very least above 8%. And here we've got 104% and 63%. So those two metrics are very, very important. And most people speak about earnings and earnings growth, but return on equity and return on invested capital are as important, if not more, because if you have a company that makes money but then reinvests the money in an unprofitable way, it will not go well down the line. Okay, and those two metrics also show how the management allocate capital, if they can do that effectively or not. So return on equity, return on investment on invested capital, excellent. Debt to equity ratio, excellent. We want something under 200%. Here we've got only 7%, so that's perfect. Interest coverage, so that's basically the ability of the company to pay its debt interest. So very good here. We want a minimum of 3, and we've got 500, so they can easily pay their debt interest. Current ratio, we want something above 0.8, and we've got 4. So the current ratio is the ability of the company to service their short-term obligations, like for example invoices, etc. So quality score out of 8, we want a minimum of 7, and here we've got an 8 out of 8, so excellent. So does it mean that you can or that I should personally invest in Nvidia? No, it's only 1 question out of 3. You can see here 1 question, 2 question, 3 question. You can invest in a great company. If the price is not good, it can end up being a very bad investment. Okay, so question 1, is it a good quality company? The answer is yes. Let's go now into the question number 2. So in the question number 2, we try to estimate the return, the annual return of the company over the next 10 years. Okay, and this of course depends on the price. So here we've got 177, and we've got a projected 10-year internal rate of return. So that's basically the annual return of the company of 15%. But let's say now that we had 277, then all of a sudden it becomes a bad annual return. Okay, so here I want a minimum of 10%. Here we've got 15% for this share price. So once again, the question is good expected annual return, yes or no, and the answer is yes, 15%. I like that. I want a minimum of 10%, but ideally I want in a perfect world, I want 14, 15, 16, 17%. Okay, so I've got a margin of safety, and if there is some bad news down the line, or if some of my assumptions end up being a little bit incorrect, then I still have this big margin of safety that will allow me to make money anyway. By the way, I received many messages of people who are interested in our automated Excel tool. Well, this tool is part of our broader Warren Buffett value investing strategy toolkit, which includes all you need to know to think and invest like Warren Buffett. I'll put a link in the description so you can download it if you're interested. We have now more than 200,000 professionals leveraging our toolkits, and hopefully you'll be one of them. Many people ask me how I retrieve the financial data. Well, I'm using FMP Financial Modeling Prep, which I highly recommend. It saves me a lot of time, simple to use, and the quality of the data is very good. If you're interested, I will leave a link in the description with the discount code. Question number 3. So most people focus on those 2 things. They never spend too much time on this one, but this one is very important. So the third question that you need to ask yourself is this investment a good fit for you? Okay, so this of course does not update automatically. It depends on your own situation. It depends on my own situation. So you need to manually update this building block. So here, it's very important to answer those statements, okay? The first one is, I understand the business model, yes or no? If I don't understand the business model, then I shouldn't invest in this company, even if the answer to question 1 and question 2 is yes. It does not matter. You have to be highly convicted in this company. You have to understand the company, understand the business model. You have to read the annual and quarterly report. You have to know the industry and the competitors. You have to be willing to invest more on price weakness, etc. And also, another one that I want to mention, this investment should fit well in your portfolio. Okay, so all of this is very important. Why is that? Let's say that you invest in a good company at a good price and with a high expected annual return. But now let's say that the share price drops by 30%. Totally possible. That's part of the game. It does not matter. Even if you answer correctly to the first 2 questions, there will be some time to time where the share price will drop by 20-30%. Not a problem at all. If you understand the business model, if you're highly convicted, if you believe in this company, then you will just be almost happy about it, because you will have an opportunity to do a second investment at even a better price. Okay, let's say, for example, that here we have an expected annual return of 15% at $177. Okay, now let's say that the share price drop from 177 to 140. Well, you should be extremely happy about it, because all of a sudden you have an annual return over the next 10 years, not of 15%, of 18.4%. That's a tremendous difference. Tremendous difference. But the only way for you to take advantage of this price is to be highly convicted by this company. And to be highly convicted, you need to understand the business model, you need to spend time reading the annual and quarterly reports, etc. Okay? Fifth block. So here it's kind of a decision matrix, with 3 dimensions, which are aligned with the 3 questions, of course. So here we've got the dimension number 1. So is it a good quality company? So if the quality score is above or equal to 7, then the company will end up being here. Second dimension, that's your annual return, expected annual return over the next 10 years. If it's above or equal to 10%, then the company will end up being here. And then the last dimension, which is this investment a good fit for you? Well, if it's green, it means that it's a good fit for you. Otherwise, it means that it's not a good fit for you. So let's say, for example, that for the statement, this investment fits well in my portfolio, let's say that the answer is no, because let's say you already have many companies in the same industry, in the same country, so you don't want to be heavily concentrated, let's say. So it's not a good fit for your portfolio. So then the question becomes no, and then Nvidia become red here. Okay. So in my case, since all of this checklist is ticked, the answer is yes, and as a result, Nvidia is green. So the bottom line is that I should consider investing in Nvidia at this price. Okay? So executive summary or investment summary, very important section, but I like to go a little bit deeper into the company. So the second section that I like to review is called fundamentals. So here we basically have those 8 metrics, but we deep dive a little bit more. So for example, we've got those metrics, but over time. Okay, so let's start with revenue and earnings growth. So we can see, for example, that over the past 5 years, the compound revenue growth was 67%. Excellent. The past 5-year compound earnings growth was 94%, even better. We also have the future consensus growth of 25% for the next 5 years for the revenue and 26% for the earnings. So those numbers will help us fine-tune our own assumptions, but you cannot just copy-paste the consensus, because the analyst consensus tend to be a little bit over-optimistic, you know. So it's usually I like to have a number that is a little bit lower than the consensus, and you know, I prefer to be conservative. Okay, so that was the first building block. Second building block of the section fundamentals, so revenue and earnings. So historical, we can see in dark blue that the revenue goes up. I like to see that. Same thing for the profit. Great. So that's the historical part. That's the consensus forecast. Okay, very good. Profit margin. So here, that was more the profit margin, the TTM, trailing 12 months. But it's very good to see how it evolves over time. So here we can actually see that it has improved. We were at 26% in 2021, and in 2026 we're at 55%. Okay. Return on equity, we want a minimum of 8% at the very least, and we've got way over that. And not only that, but we can see a trend that tends to go up a lot. 25% in 2021, 76% in 2026. Great number again, great numbers. Then the return on invested capital, same thing here, 17% in 2021, which is already very good. And now we've got 62.9%. Excellent. Okay. Debt to equity ratio, we want a maximum of 200%, but ideally we want way lower than that, and that's exactly what we have here. And not only that, but the trend is down, which is exactly what we want. Interest coverage, perfect, is going up, and it's way higher than the threshold of 3. And finally, current ratio, that's our 8th metric. Current ratio, something very solid, always between 3, 4, 5. That's excellent. Okay, so now let's zoom on the third section of this tool, which is called valuation. So how do we value a company? Well, we mainly use 2 metrics. The first one is called owner's earnings. So what is owner's earnings? That's a concept that has been coined by Warren Buffett, and that I believe is the best metric to use when you want to assess the intrinsic value of a company. So what it is, it's basically an estimate of the earnings that could be distributed to the shareholder, potentially distributed to the shareholder, without shrinking the business. Okay? So the formula is very simple. You start with earnings, you add depreciation and amortization, which are non-cash item. Then you also add true non-cash item. You exclude SBC, which are not true non-cash items. They are non-cash items, but they are real. They have an economic value, because when you give stocks to your employees, you dilute basically you dilute the number of share outstanding, which basically hurt the shareholder. Okay. Then you subtract maintenance capex. Okay, I'll do another video to explain exactly the difference between growth capex and maintenance capex. Then you subtract one-off gains and income, and you adjust it based on the tax. And then you add one-off losses and expenses. Okay, so here our model calculates automatically owner's earnings. I like to refine these numbers because this is based on raw numbers from FMP, but I've got more context because I can read the quarterly report, the annual report, so I can, for example, have a better understanding of the part of the capex that is maintenance capex as opposed to growth capex. So I can adjust a little bit the numbers here, okay? And as soon as I adjust them here, the model input will change and will take my own assumption. Okay, so if I remove this, it takes the raw estimate, and if I add this, it takes my refined estimate. Okay. Second building blocks, that's a bridge between earnings and owner earnings. So I'll let you have a look, but basically we've got earnings here, and then we've got all of those items, and we end up with an owner earnings, which is more or less the same as earnings, but based on for other companies, you could see a very big difference between this number and this number. Okay. Then building number 3, owner's earnings growth rate. So that's also a very important metric. We want owners earnings, but we also want the earnings growth rate of the company. So here, same thing. We've got some raw estimate based on the consensus, but I like to come up with my own estimate. So I like to refine those estimates. Once again, I've got a lot more context. I've got my own conviction, and I like the fact that at the end of the day, I decide the assumption that will help me estimate the intrinsic value of the company. Okay. So, for example, here 27%. So this is a rare situation where actually my estimate is higher than the consensus. Usually it's lower, but you know, it's Nvidia is a little bit of an exception. I'm a big fan of Nvidia, and I'm convinced that they will do very well in the future, and especially at the price of $177. Okay, so I've got my estimate here for year 1 to year 5, for year 6 to year 10, and then I like to have a perpetual growth rate of 2%. Here I'm being conservative because I prefer to be conservative than over-optimistic. Building number 4, owner earnings estimate. So we can see that it's going up, it's nice, I like to see that. Price versus intrinsic value. So here we've got a market cap which is way lower than the intrinsic value, and we've got the share price that is lower than the share intrinsic value. So I like to see that, and to be more precise, the price is 31% below intrinsic value, based on our assumptions, of course. And as a result, the 10-year annual return based on the current share price, or on the share price of $177, is 15%. Okay, which is the number we had in our investment summary. If you want me to analyze a specific company, let me know in the comments, and don't forget to subscribe. Thanks a lot for your attention.